Most people say, I want to retire early. But when I ask them one question, how much money do you actually need? Silence. If you don't know the number, you don't have a plan. And without a plan, retirement is just a fantasy. Indian reality in India. Early retirement still sounds unrealistic. We grow up believing retirement means 60 plus years old, EPF pension, maybe some FT. But today, a 28-year-old software engineer in Bengaluru, a 32-year-old CA in Mumbai, a 25-year-old startup employee in Gurgaon, they're asking a different question. Can I retire by 45? The answer is yes, but only if you calculate properly. Step 1. Define the number. Most important step. The biggest mistake people make. They plan vaguely. I'll retire around 45 or 50. I think 3 to 4 crore rupees should be enough. That's not planning. That's guessing. You must know your number because allocation, SIP amount, risk level, everything depends on that one number. If the target is unclear, even perfect investing won't help. The formula, the 4% rule, India version. There's a simple global framework used by investors worldwide. It's called the 4% rule. Here's how it works: take your expected annual expenses after retirement, multiply it by 25. That's your retirement corpus. Why 25? Because 1 divided by 4% equals 25. If your money generates roughly 4% safe withdrawal per year, your capital can sustain 25 plus years. Example: let's say you estimate monthly retirement lifestyle cost equals 80,000 rupees, 40,000 rupees living plus 20,000 rupees, healthcare plus 20,000 rupees lifestyle and travel. Annual cost equals 9.6 lakh rupees. 9.6 lakh rupees times 25 equals 2.4 crore rupees. That's today's value. Now adjust for inflation. India's long term inflation average is 5 to 6%. If you plan to retire in 20 years, that 2.4 crore rupees may actually become 5 to 6 crore rupees. That's your real target. Suddenly, retirement feels serious. Step 2. Audit your cash flow. Now, second step, check your surplus, not your income, your surplus. Many people say, I earn 1 lakh rupees per month. But when we audit rent, EMI, groceries, subscriptions, travel, actual savings, 15,000 rupees. You cannot plan retirement on imagination. You must list fixed costs, rent, food, utilities, variable lifestyle expenses, annual irregular expenses, then calculate true monthly surplus. Rule 1: personally follow. Use only 60 to 70% of surplus for retirement goal. Remaining 30 to 40% goes to emergency fund, skill upgrades, lifestyle buffer, never overcommit. Consistency beats aggression. Step 3: required return calculation. Now plug numbers into compounding math. If your goal is 6 crore rupees in 20 years and you can invest 30,000 rupees per month, you'll need roughly 13 to 14% CAGR. Is that realistic in India? Yes, say if portfolio is structured properly. Long-term Nifty returns historically hover around 12 to 14%. But if your math demand 18 to 20% CAGR, that's dangerous. Even Warren Buffett's long-term average is around 20%. If your plan requires unrealistic returns, you adjust. Extend timeline. Increase savings rate. Reduce retirement expense target. Don't gamble. Engineer it. Retirement versus financial freedom. Important distinction. Retirement corpus is survival number. Financial freedom corpus is comfort number. Retirement equals you can survive 30 years. Financial freedom equals you can live freely without fear. Financial freedom corpus is usually 30 to 40% higher. So if retirement target equals 6 crore rupees, freedom target may be 8 to 9 crore rupees. Both are valid, but clarity matters. How to invest for 14%? Target India mix. To target 14% long term, you need a blended portfolio. Example structure: equity mutual funds slash index funds, Nifty 50, FlexiCap, core, direct equities, limited allocation, real estate, growth plus rental yield optional, gold, hedge, debt funds slash bonds, stability. During accumulation phase, focus on growth. After achieving target, shift to liquidity. When retired, priority changes from return to cash flow. High liquidity assets become more important than high growth assets. Many retirees fail because assets are locked in real estate. Plan liquidity in advance. What can derail your plan? Three biggest risks. 1. Career instability, freelancing without buffer. 2. Health shock. 3. Lifestyle inflation. Solution: 6-month emergency fund, health insurance, annual review of expenses. Retirement planning is not a one time Excel sheet, it's a living system. Low income, start early. If you earn less, start earlier. A 25-year-old investing 5,000 rupees per month for 30 years beats a 40-year-old investing 20,000 rupees per month for 15 years. Time is the biggest asset. Compounding rewards, early discipline, actionable steps. Today, 1. Write down retirement age. 2. Calculate annual expense. 3. Multiply by 25. 4. Adjust for inflation. 5. Check if your current SIP matches target. No guessing, only numbers. Comment below what's your retirement number? Because if you don't define it, you will work longer than you need to. Plan smart, start early. Let compounding do the heavy lifting. Retire at 40 with 50,000 rupees salary. Retire at 60. That's the old script. What if I told you? You can retire at 40 in India, not with luck, not with crypto gambling, with aggressive, structured execution. But this path is not comfortable. Why 40 is possible in India? India is in a multi decade growth phase. Young population, digital economy, formalization, rising equity participation, GDP expansion. If there was ever a country where aggressive compounding is possible, it's India. But you need high savings rate, equity, heavy allocation, income growth focus, ruthless discipline. This is not save a little and hope. This is engineered fire. Step 1. Define your 40 target. If you want to retire at 40 and you're 25 today, you have 15 years. That's it. Now let's define the number. Assume post retirement lifestyle 1 lakh rupees per month. Annual expense equals 12 lakh rupees. Using 4% rule, 12 lakh rupees times 25 equals 3 crore rupees, today's value. Adjust for 15 years inflation at 6%. Target becomes roughly 7 to 8 crore rupees. That's your aggressive retirement number. If you want premium lifestyle, 10 crore rupees target. No guessing, only math. Step 2. Extreme savings rate to retire at 40. Your savings rate must be 40 to 60%. Yes, minimum 40%. If you earn 1 lakh rupees per month, 50,000 rupees must go to investments. If you earn 60,000 rupees, at least 25,000 rupees must go to investments. This phase is sacrifice phase. Low lifestyle inflation, shared accommodation, controlled EMI, no status spending. Most people fail not because income is low, but because lifestyle grows faster than income. Step 3, aggressive portfolio structure. This is not a conservative retirement plan. This is aggressive accumulation. Suggested model age 25 to 35. 70% growth assets or index funds, Nifty 50 slash Nifty Next 50, or FlexiCap mutual funds, or select mid cap exposure. 15% opportunistic satellite plays, or thematic funds, or small direct equity exposure. 10% gold, hedge, 5% emergency liquidity, no FTs dominating, no over allocation to real estate early. Liquidity plus scalability matters. But remember, never put 100% in high risk. Aggressive not equal to reckless. Step 4, target 15 to 18%. CAGR to hit 8 to 10 crore rupees in 15 years. You likely need 15 to 18%. CAGR. Is it possible in India? Yes. Historically, mid-cap indices and disciplined SIP strategies have delivered strong double-digit returns. But here's the reality. Some years plus 25%. Some years minus 20%. You must emotionally survive volatility. If you panic sell during correction, retire at 40 becomes retire at 65. Mental strength greater than intelligence. Step 5. Income growth is non negotiable. Investing alone won't do it. You must increase income, upskill, switch companies, build side income, freelance, build digital assets. If salary grows from 6 lakh rupees per year to 20 lakh rupees per year in 10 years, your compounding accelerates exponentially. Aggressive fire equals income growth times investment growth, not just SIP. Step 6, exit strategy at 40 important. At 40, you don't stay 70% equity, you rebalance. Shift toward 40 to 50% equity, 30% debt funds slash bonds, 10 to 15% gold, 10% liquidity. Why? Because once retired, capital preservation becomes priority. Growth builds the wealth, stability protects it. Big risks to this plan 1. Overconfidence during bull market 2. Quitting job too early 3. No health insurance 4. No emergency fund 5. Unrealistic return expectations. Aggressive doesn't mean blind, it means structured boldness. Reality check. Retiring at 40 doesn't mean doing nothing, it means you don't depend on salary, you work because you want to. You choose projects, you choose time. Financial independence greater than early retirement label. Action plan. If you're 25 to 30, 1. Calculate retirement number inflation adjusted. 2. Increase savings rate to 40% plus. 3. Automate SIP immediately. 4. Increase income every 2 to 3 years. 5. Review CAGR annually. 15 years goes fast. Don't waste first 5. Comment below 40 by design. If you're serious about retiring at 40 in India, this path is intense. But discipline today buys freedom tomorrow.